You finally got your credit score up. You've paid down your credit cards. You've corrected your errors. You've been watching your score like a hawk. Then you apply for a mortgage and still here, your debt to income ratio is too high. But wait a minute. You thought your credit score was the main thing standing between you and home ownership. But here's the truth. A better credit score may help open the door, but your income and your monthly debt payments help determine how much you can actually carry through that door. Now today I'm going to show you exactly how that works. So remember, credit ready isn't always mortgage ready. So what's going on? You fellow credit renovators out there know me. I'm Highly the Credit Renovator. For those who don't know me, I'm Highly the Credit Renovator. Now today we're going to be talking about one of the most misunderstood parts of becoming mortgage ready, the debt to income picture. Now I like to talk a lot about credit because credit does matter. Your payment history matters. Your balances matter. Your credit profile matters. But your credit score is not the entire mortgage calculation or application for that matter. You have a decent credit score, but you still struggle to qualify for the home at the price that you're looking for. You could also have an improving credit profile, but discover that car payment, those student loans, those credit cards, personal loans, or any other mortgage obligations that have to be counted are consuming too much of your qualifying income. And sometimes the problem is not how much you earn. It's the problem or issue or reason is that it's how the lender is allowed to calculate that income, qualifying income, and calculate that debt, qualifying debt, and document what you earn. It's an important difference. And so in this masterclass, we're going to cover what debt to income ratio actually means, which monthly obligations can be counted, how lenders evaluate income stability, why the income that you actually receive may not be equal to the income that we can use for qualifying. How is self-employment, overtime, bonuses, or any side hustle income, how is it treated? Can it be used in the qualifying process? And some practical ways to improve your mortgage readiness without chasing credit scores alone. Now, I want to ask you, make sure you stay with me until the end because I'm going to give you a 5-step debt to income renovation plan that you can begin using before you apply for any mortgages. So let's build it together. Now, first and foremost, what is debt to income ratio? Is exactly like I said before, but we're going to start with a basic definition. Your debt to income ratio, also known as DTI, is a percentage of your gross monthly income that goes towards qualifying your monthly debt obligations. Gross incomes means you're paid before taxes and before any other deductions. The basic DTI formula is we take all your qualifying monthly debt payments and we divide that by your qualifying gross income. So, example, your gross monthly income is $6,000. You have a $550 car payment, $200 in student loan payments, $150 minimum payment on your credit cards, and then say the proposed PITI monthly payment on that house you're looking to buy is $1,700. So if you add all those together, that's $2,600 in monthly obligations. So if you took that $2,600 divided by the $6,000, that would make your total DTI approximately 43%, 43.3 to be exact. But I need you to understand something that's very important. That number does not automatically tell us whether you will be approved or denied. Remember, there are different loan programs, different lenders, and different underwriting standards and systems that are applied for different requirements. So your full application may also include such factors as credit history, your cash reserves, down payments, property type, the loan type, and the stability of your income. How long do you get it? Is it regular? Is it consistent? That's why you should carefully, be careful when somebody on the internet says, you must have a DTI below this number or that number. Or they'll tell you that this program always allows a DTI up to this number or that number. Mortgage underwriting, a lot like credit, is rarely that simple. That DTI percentage, it is an important measurement, but it's not the entire decision. See, unlike an automobile loan or credit card loan, which is usually done by an algorithm looking at one credit bureau, it looks at the information on one bureau and your score, and it makes a decision. Mortgage underwriting, though we are using technology in assisting, we're using these tools, still a human being that got to make the final call. Now, to make it even more confusing, not only do you have DTI, debt to income ratio, you have a front end DTI and a total DTI. So if you've ever heard your mortgage lender make reference to that, here's what the two and the difference between them. Okay. The front end ratio is also known as the housing ratio because it's exactly that. This is where they do the debt and the gross income, but in the front end, they're only looking at the debts related to the house. They call it the housing expense. So that would be the principal payment, the interest, property taxes, the homeowner's insurance, MI insurance if it's applicable. That's when you're putting down, it's required when you put down less than 20% on your loan. If you got a condo or a townhouse that has a homeowners association and any dues, homeowner association or maintenance fees. And then, of course, if there's any other housing related obligations, say if you're buying a mobile home, then you usually have to finance the home itself. You may be leasing the land if you don't own it yourself. So you'd have to add that into the calculation. Sorry, I had to have that. But this is why when looking at only the property's advertised mortgage payments, that it can cause confusion and often sometimes be misleading. A real estate listing may show you the estimated P&I payment, principal and interest, but it is not necessarily your complete monthly housing expense. That's why you hear a lot about PITI and things like that, because it's those other things I just listed. But remember, the lender has to consider all of that, the appropriate taxes, insurance, mortgage insurance, and applicable association fees. Now, the second ratio, that's your total DTI. That's the one most people think about, also known as the back end. That's where we add everything from the proposed front end to housing, plus all your other stuff. And this is the part where a lot of first-time home buyers get surprised. They'll say, I can afford a $1,700 mortgage payment because I'm already paying $1,600 in rent. Now, I do understand the logic in that, and it's valid. But they have to remember, particularly in mortgage qualification, not only that, in the real world when they're living this budget, they have to remember that the qualification is not based on whether or not you've been paying a similar rent or not. The lender considers that you have a similar housing expense because sometimes when people buy a house and their new payment is substantially above their old one, we call that payment shock. And we try to avoid that because we're always concerned that that new budget may put a strain on the home buyer's situation. So the lender considers those other obligations besides the housing expense, along with the new housing expense. So if you got a $750 vehicle payment, student loans, credit card minimums, personal loans, or any other obligations, those payments can reduce. And when I say other obligations, could be child support, any of those. those can reduce the amount of house payment that you can qualify for, because if none of those back end ones can be moved, we got to make this front end one smaller. And so at least your credit report does tell that part of the story, because we usually look at what's on credit. But your DTI tells another part. So which debts actually do count in your DTI? Let's go over that. So depending on the loan program and the circumstances, like I said before, lenders may consider payments associated with the following. Here's what they got to look at. They will look at your auto loans, student loans, credit cards, personal loans, any installment loans, any other existing mortgages. You may own a second home, vacation home, something like that. Any home equity lines of credits related to any other homes, or in the case this, because you might, in this situation, you might be doing a refi. If you got alimony due, if you pay child support, if you've co-signed on anybody else's debt, and you guys out there who know me and know my videos and talk to me, they know what I think about co-signing. Any lease payments you may have agreed to, any tax repayment plans with the IRS or any other municipality, or any other recurring debts that may show up on credit or that we know will show up in some sort of database search. Now, this list is not all inclusive. There are others, but the best thing to do is if you have any obligations that you committed to, you want to let your loan officer know that, so they can look and see and check with underwriting on an individual basis to see if that's something that has or has not have to be included in the calculation. Now, one important detail about the DTI is really, it's driven by the required monthly payments, not the balance. Now, however, there are cases when you have an outstanding debt. If you usually have three or less payments left, we don't have to count it. Things like that. But we have to look at them on a case-by-case basis. So example, you got two people. You got person A, you got Johnny. Johnny owes $8,000 on a high payment personal loan with a required payment of $500 a month. Then you got Jimmy. Jimmy owes $18,000 on another obligation with a documented required payment of $200 a month. I promise y'all, it's not one of those if train A meets train B at the station type of questions. These separate situations, separate considerations. But I do want to show you the difference, because if Jimmy, because he owes more money than Johnny, but keep in mind, Johnny's obligation has a larger monthly payment, so his impact on DTI is higher, even though he owes less money. So it doesn't mean that total balance doesn't matter at all, because total balance, if it's revolving, can affect your credit utilization, which we talked about that, guys. And so it also could have an impact on reserves or other parts of the application. But since we're concentrating here on DTI, let's focus on that and just figure that the total required monthly obligation is often the critical figure that has to be counted first. This can lead to mistakes that I see people make all the time that I've seen. And what they do is they send an extra $2,000 towards the debt and they'll try to pay it down. But that doesn't affect the monthly payment, so they did all of that for nothing. Now, reducing the balance may be great for interest savings or credit utilization issues, revolving credit, but if your goal is to specifically reduce your debt-to-income ratio, DTI, you need to know whether that payment will actually be lowered or eliminated or included in the first place. But don't assume. Ask your mortgage professional to model it before you move that money. So you want to take money from your reserves to pay something down, thinking you're helping when you're really not. So you want to always have a strategy. Now let's talk about the co-signing trap. You guys know how I feel, but I got to say it for those out there that don't know me. Okay, you decided to help out a family member. You helped your daughter, your son, your brother, your sister, your mother, your father. Now, they might make every payment. The vehicle is theirs. You don't drive it. You might not even remember the last time you saw the car. But your name is still legally attached to that account. You might not be attached to the car, but you are attached to the account. That means that payment is appearing in your debt picture unless the lender can document that it qualifies for some sort of exclusion under primary programs. Sometime it can. If you can show in some situations, some underwriting, if you can show that the primary lien holder has made all the payments for as long as possible, you can argue that you don't really have to be counted against you because they are and have been fully responsible for that debt in its entirety up until this point in time. All right, and so it helps. But remember, the rules and the documentation requires different on your loan product. So check with your mortgage lender. But the lesson is simple. Don't wait until application day to investigate any co-signed accounts. Pull your reports early. You know how I feel about that. Identify every account connected to your name. That's why I would do a credit audit for you if need be. Then ask your mortgage professional what documentation may be needed to discount and exclude any debts that you have co-signed on. And please hear me on this. Co-signing is not simply lending somebody your credit score or signing off or overcoming a difficulty and helping them get a car. It can lend them part of your borrowing future. Because as long as that debt exists, it's going to be counted against you. And as long as it's on your report, their credit behavior affects you. Co-signing is a serious financial decision. I recommend you don't. But if you must, if you really want to help somebody, really think it through and consider how it's going to really affect you. It's not a painless favor. Now let's talk about student loans and how they affect DTI. Student loans deserve their own section because they do create a lot of confusion. Some borrowers believe that if their student loan payment is currently at zero, that the loan will have no effect on their mortgage qualification. And that is not always correct. Depending on the loan program, depending on the payment status, depending on the credit report information, and any other available documentation, an underwriter like myself may be required to use a calculated payment or some other documented amount. The rules differ between FHA, conventional, that's Fannie and Freddie, VA, USDA loans, and some other special private mortgage programs. But that means you should never rely on social media statements like, my student loan payment is zero, so I don't have to count it. Instead, you want to collect your current student loan statements. You want to collect your repayment plan information. You want to collect any and all documentation showing what your required payment is and any information that your mortgage professional might need in additional, because they're usually probably getting instructed from an underwriter for additional information. Then you want to ask them, what monthly student loan payment will be used to calculate my DTI under the program? This is what you want to be asking the loan officer directly. It's a useful question. Not a simple question like, do student loans count? But specific to your situation. And you want to say, how will my student loans be calculated for this specific program that you have in mind for me? A zero payment, an income-driven payment, a deferred loan, or a standard repayment amount may not be treated the same way. They all have a net effect of being reported on the credit report as zero, but that doesn't mean they'll be treated the same for the purposes of mortgage underwriting. This is one more reason why mortgage readiness requires more than just checking your credit score. Now keep in mind, your income isn't always your qualifying income. Now, you may earn $75,000 a year. You may assume that the lender will simply divide that number by 12, since the calculation is relatively straightforward. Sometimes, other times it isn't. Now, mortgage lenders generally need income that is verifiable, documented, that it's stable, and reasonably expected to continue. Yes, we know, so anybody can get laid off, anybody can get fired, their plant could catch on fire, and they could be referred anyway. But the important word here is qualifying income. Not really word, but a phrase. But qualifying, not just income, but qualifying income. Now, qualifying income is the income, the amount that the lender can use, that he or she can document and use under the applicable underwriting rules for that loan program. You may receive income that cannot be used or can't be used yet because the history, consistency, or documentation or likelihood of continuance does not satisfy the requirements. Let me give you an example. Well, think of it this way, okay? You might make overtime. You might have bonuses. You might make commission. You might have seasonal employment. You could have multiple jobs. You might have a part-time job. You could have self-employment income. You might have contract work. You might have gig income like Uber, Lyft. You might have rental income from a rental property or some other item that's rented. You could be receiving some sort of support payments, child support, spousal benefits, alimony. You could be getting retirement. You can still qualify with retirement or some sort of benefit income. But it could be just about any other variable source of income. Many of those have to be considered on a case-by-case basis. Now, it doesn't mean that these income sources are not automatically unacceptable. It means that documentation and history matters. Those of you who are my credit clients and those of you who work with me in business and funding, you guys know I always talk about documentation. Documentation is everything. You got to be able to prove it and support it. If you recently started earning overtime, the lender may need to determine whether it has a sufficient history and whether it's likely to continue. We usually do that in mortgage through a verification of income or verification of employment, which has the income piece on it. Now, if your commission income changes, if you earn commission and that changes from month to month, we usually use averages to calculate it to kind of smooth things out. Now, if your recent income is declining, simply averaging the higher and the lower doesn't solve the problem. We don't do that. If we got declining income, we go with the lower amount. And we may have to do some analysis and an explanation. Definitely is going to be in order. Now, if you have a second job, the lender may be able to evaluate your history of working multiple jobs. So when a borrower says, but I know how much money I make, the lender's question is different. The lender says, how much stable income can we verify, document, and use for qualifying? Now, do you really need 2 years on the same job? I want to correct, in the spirit of credit chaos theory, let me correct another mortgage myth. Because you might have heard this somewhere. You must be on the same job for 2 years before you can get a mortgage. The statement is way too broad. Lenders evaluate employment and income history, yes, but that does not mean you have to be at the same employer for 2 uninterrupted years. A job change within the same field may be treated differently from a major change in employment structure. So it's not like if you change jobs and you work in a similar field, That's continuous. Now, if you go from a salary job to a sales job, that's a little different because unless you have proven sales history earning commission, we may feel like that strain of making that transition may be too much for you. Or say, for instance, you got a recent graduate who's entering a field related to their education, and they may have a different documentation story. Now, someone moving from salary to self-employed may face different requirements, similar to what I was talking about with someone going from salary to commission. Now, because for the same thing, the nature and predictability of the income has changed. It's a far cry to go from earning hourly to earning self-employed because it's just different challenges to earn a living. Someone with frequent unexplained gaps or significant income instability may need even more documentation. Why so many changes? Why is this a volatile field? Is this person having difficulty holding a job, a position? Now keep in mind, the issue is not simply just have you been sitting at the same desk for 24 months. The issue is whether the lender can establish that the income is acceptable, stable, documented, and likely to continue under the applicable guidelines, again, for the lender, for the program, and for general underwriting consideration. So don't automatically cancel your home ownership goal just because you changed jobs. But also you don't want to be trying to make any major employment changes during the mortgage process or the mortgage lending process without talking to your loan officer first. Now, if you're going from W-2 employment to self-employment, if you're reducing hours or switching to a commission only from salary or taking unpaid leave, those things can really affect your qualifications, so you want to be careful with those. Now, even if an opportunity to change jobs sounds better, the timing can matter as well. Now, keep in mind, this is another one. If you're self-employed, it does not mean you're unqualifiable. But I want you to pay close attention if you are. Being self-employed does not automatically prevent you from obtaining a mortgage. But the lender may calculate your income differently from the way you think about your business revenue. Because revenue is not qualifying income. Because if your business brings in $150,000 a year, that does not mean you have $150,000 in income to qualify with. Because the lender is going to look at it very different. The lender is going to look at both your personal and business tax return. We're going to look at your structure. We're going to look at your ownership percentage in the business. We're going to look at profit and loss statements. We're going to look at balance sheets. We're going to look at business bank statements. We're going to look at trends in your earning, ups and downs in your deposits. We're going to look at non-recurring income or non-recurring expenses. And then we're going to look at whether the business appears to be able to support continued distributions to you as salary, as your earnings, so that you'll have money to pay your mortgage and we don't have to worry about defaults. Now, sometimes I've seen this many times where tax planning and mortgage planning sometimes bump heads, or more accurately pull in different directions. I've seen where I have a loan officer says, oh, I got this guy, he makes a lot of money, his business makes a lot of money. But keep in mind, oftentimes when I see tax returns, what I see happen is their tax person tells them to expense a lot of things in an effort to pay less taxes. Now, they'll be doing what's legal, and they'll max out the deductions to reduce their taxable income. But those deductions also reduce the income available for mortgage qualifying. No. Now, of course, there's certain eligible non-cash and non-recurring items that receive a little different treatment, but we're not going to go into all of that. Basically, self-employed buyers should not wait until they are ready to make an offer by having their income reviewed, having their tax returns reviewed, so we don't know exactly which one. Because if you look at a tax return, you'll see line 30. So those of you out there know what I'm talking about. Line 30, that's the one for qualifying. Not revenue, not line 4 on the business return. But ideally, you want to speak with a knowledgeable mortgage professional as well as a tax professional well in advance of applying for anything, so you'll know where you stand. And you don't want to start trying to get amended returns and change your tax returns or ignore legitimate deductions merely to qualify for a loan, because that's kind of like fraud. Instead, understand how your actual file returns may be interpreted before you set your home price expectations. Planning beats surprises every time. Okay, let's talk about the 3 levers of DTI. If your DTI is too high for your desired mortgage, you generally have 3 broad levers. First thing you can do is reduce your monthly obligations. That might include paying off a particular obligation you loan just to get that off your monthly pay roster. You may want to pay down a revolving account enough to reduce the payment, because remember, with revolving accounts, the minimum payment is based on the balance. You may want to avoid any new monthly payments. You definitely don't want to go out and buy anything. Maybe you had a vehicle, you want to sell that vehicle, but you got to be careful with that too, because if you sell a vehicle and you don't have another vehicle, the underwriter's going to say, well, wait a minute, selling that vehicle, obviously they're going to have to go out and get a new one. So unless they already have another vehicle, then we'd have to prove that if they sell their vehicle, that they're going to have to go out and get a new loan to get a new vehicle. So that has to be considered. Now, you can also restructure any of your eligible debt when it's appropriate. So again, it's one thing to make adjustments. It's another where you're trying to circumvent. Or you may be able to document any obligations that qualify for exclusion. Something being paid by somebody else if you co-sign, things like that. But what you don't want to do is just randomly go out and start paying off accounts without a plan. Because a $3,000 payoff might eliminate $300 monthly obligation, and you may have a very different DTI effect. But it would be different if you took that $3,000 and reduced another obligation, and that only saved you $40 a month. So you got to think it through if you want to try to pay off stuff to qualify. You have to compare the cash required with the monthly DTI improvement. So lever number 2, you want to increase documentable qualifying income. We talked about that before, that qualifying income. And the key word here is documentation, documentable. Picking up a side hustle 3 weeks before applying for a loan may put some extra money in your bank account, but it won't immediately become qualifying mortgage income. A raise in stable base pay, however, is treated differently from new variable source income. So if you got a raise, that raise can be included in your qualifying income, because generally speaking, employers can't and don't take wages away. Now, overtime, bonuses, commission, or second job income may require acceptable history. You would have to have a history of receiving overtime and a likelihood to continue. Same thing with bonuses. Same thing with commissions. So don't just ask, how can I make more money? Ask, what income could be documented and considered under the mortgage guidelines, and what kind of history would be required if I'm trying to use it for qualifying. And then thirdly, you have the option to reduce the proposed housing. Like I said, if your DTI is too high and you can't reduce any of your debts, the back end stuff, you may have to reduce something on the front end. You may have to adjust your target purchase price and move it down. You may have to put more money down to have a lower loan amount, mortgage loan amount. Because the more you put down, the less you borrow. The less you borrow, the lower your payment's going to be. You might consider comparing eligible loan structures to see if you qualify for that. DTI might be good for one but not another. You might want to consider shopping for lower homeowners insurance, because maybe in the DTI calculation you got a policy or premium that might be overpriced, so you may want to reduce some things to make it more affordable. You may want to consider different property tax, move to another area, choose a house in an area that has lower property taxes over another but have similar amenities. You may want to evaluate things like not getting an HOA or a condo, a townhouse or a condo because of the HOA costs involved, and just get a standard house that has just the PITI. You may want to explore seller or lending options with your mortgage professional, seller credits, seller considerations, things like that could help you lower that loan as well. Or you maybe take a step back and wait and see if you get a stronger financial position down the line. Now notice that I said reduce the housing payment, not simply find a cheaper list price. Because just because you might buy a lower house, that may not make your price any lower, because remember, the part that impacts it is the mortgage, the loan part. A lower priced property with higher taxes, higher insurance costs, or an expensive HOA will not produce the monthly payment reduction that you're looking for. So always evaluate the whole picture when making those decisions. Now, let me give you a 5-step income debt renovation plan. But before I do, I'm going to ask you to do me a favor. If you have not subscribed to my channel, I would please appreciate that you would. I'm trying to get to 1,000 subscribers so that YouTube can push me out further into the webosphere, and I can help more people and they can enjoy this information just like you guys are. So if you've already subscribed, please share with somebody you know. If you haven't subscribed, please subscribe, and I appreciate your comments. Give me ideas for future video topics that you want me to go over. And so if you can do that for me, I really would appreciate it. So in the 5-step debt to income renovation plan, let's bring this all together. First of all, you want to calculate your current DTI. You want to list your gross monthly income and every monthly debt obligation. Then you want to calculate your ratio before adding in the new mortgage. Now, while this is not your final underwriting calculation, it's your starting estimate. It's that front end DTI that I talked about. Step 2, you want to estimate your future housing payment. You want to include more than just the principal and interest payment. You want to make sure you include your property tax, your homeowner's insurance, MI if you're putting less than 20% down. If you got a condo or a townhouse, any and all HOA and maintenance fees have to be counted, and any other required housing expense. Now, you add that to the projected payment for the property, the house you're trying to buy. That'll give you your front end housing obligations. Step 3, you want to verify your income documentation. Gather all the documents that support your income, like I said. Now, depending on your situation, this might include pay stubs, recent ones, W-2s, tax returns, bank statements, and of course, any and all employment verification, like we get a verbal and then we get a written verbal verification. Any benefit letters, if that's the kind of income you're getting. Any profit and loss statements for you self-employed folks out there. And any other documentation that supports any other income that you're looking to use and for qualifying. But don't assume that every deposit is qualifying income in self-employed situations. Now let's identify the highest impact changes. That's step 4. We want to look for moves that create the greatest improvement without draining the money that you need for your down payment, for your closing costs, for your reserves, cash reserves, for moving expenses, any repairs that the house may need, and any other emergencies that could occur after closing. So, because becoming mortgage ready should not leave you financially empty. Step 5, you want to have a professional model your options. So that mortgage loan professional are going to look at all the financial options based on your situation and which loan program they have in mind for you. They want you to check out anything you're consider paying off, because before you pay off a loan, close a card, change jobs, move money around, consolidating debt, or adding a borrower to your loan, ask your mortgage professional to model the likely impact of those changes before you do anything. Because one well-planned move can be more powerful than 5 random moves. And now, a final warning. Don't create new debt before closing. Don't buy a stick of gum, at least not financing, because this is one of the fastest ways you can damage what is otherwise a workable loan in progress. This will blow your deal every time. If you take on any new debt before closing, and then, because sometimes what happens is people get excited, and they're excited about their new house, and then they get pre-qualified, they get confident, and then they go out and finance a new car. I've seen this one more than once, where they go out, they go to Ashley or somewhere, and they buy furniture for all the new rooms in their house. And because they get it now, because they want to make sure they have it by the time they close, they go out and buy appliances. They take out a personal loan for something, or they make a large credit card purchase, usually related to the new house. They're excited. They're getting ready for the new house. Now, they've changed their monthly obligations. Now, they've changed their credit profile. Now, their available funds may have changed if they did any of these things cash instead of finance. If they did it with financing, it's going to affect credit, DTI. If they use cash, now they use down payment money or some of that money if they pay cash for these things. Now your whole loan has to be reevaluated. Pre-qualification is not a permission to go out and open up new accounts. Until the mortgage is closed and your mortgage professional confirms that the transaction is complete, you want to avoid making any major financial changes without checking first. Yes, the house needs furniture, but you need a house before you need the furniture. So let's get the house first. Now, I don't know if you guys are aware that I have a school channel. That's School, SKOOL. It's a community network. What is school called? School, just a school. It's not a channel. But it's a community where folks that are in there, I offer a lot of free help, content, tools, and resources for folks trying to fix their credit, for folks interested in the home buying process, for folks who are interested in the business funding and everything about that. It's currently called the Credit Renovators Network on School. I'm thinking about changing the name, but it's easy to find. It's a free community. It does not cost anything. But there are some resources in there, some products that you can pay for, but there's plenty of free stuff in there too. But more importantly, it's a community. So if you got credit questions, everybody in the community is dealing with the same credit questions. So you don't have to feel embarrassed or shy about asking anything. Sometimes people are doing things, if you're someone that's working on your credit on your own, there's resources there to help with that. And sometimes you may get tips and helps from other folks in the community who tackled a credit issue or had a similar issue to yours. So there's a lot of value in the community, more than just learning from me. You can learn from these folks as well. A lot of people have learned their lessons as they're going along the way. And you can get a lot of moral support too, because folks are very supportive of each other because everybody has been in or is in the same boat. So inside the community, we focus on helping you understand the complete final picture, not just how to chase points on the credit score. We talk about building credit, building better credit. We talk about mortgage issues, housing issues, preparing for business funding, and creating stronger opportunities. You will get practical education in there. Many of my courses are in there. Some are free, some aren't. But even then, there are some prices in there are discounted from what I normally sell to people because I want to give love to folks in my community. There's action steps in there, there's community support, and there's other ways of guidance to help you make informed moves before you apply. The link will be in the description, so you can go there. Again, it's free, but it's a great community. It's worth a lot. You'll find a lot of value there, I believe. Come on in. Introduce yourself. Tell us where you are in your home buying journey. Tell us where you are in your credit building journey. Tell us, are you getting started? Are you rebuilding? Have you already spoken to a mortgage professional or a realtor? Because I help bring folks together in that capacity too. With almost 30 years in mortgage, I know a lot of loan officers. I know a lot of realtors, insurance folks. So if you need those resources, we have those available for you if you need guidance and suggestions and referrals on who to work with. Are you trying to solve a DTI problem right now? I have some resources in there, and I'm actually starting up a new program where I'm showing people how to create online income opportunities for themselves. Some of it involves AI, but I have programs to show you how to make money. Starting at $100, the sky's the limit. So if credit is an issue, if you got your credit licked, but income is an issue, now it might not be qualifying income, but at least you get, if you start out, you get a track record in now, it can become qualifying income eventually. But if right now you need more cash to even fund your credit building endeavors, have opportunities for that as well. So essentially, we're building together inside the network, inside the community. I really love to see you there. I want to help you succeed. Now, many of my current customers are already in there too, so they're getting the best of both worlds. They get me directly, and they get the community information that's there as well. So, remember, a credit score can help you get considered. It is a gate, but your income, your monthly obligations, your documentation, your assets, and your overall financial profile are what help determine what you realistically will be able to afford and qualify for. Remember, mortgage-ready credit is not just about a number, not about a score. It is a complete, approval-ready financial profile that's built through planning, documentation, and the right sequence of decisions. So in my next video, I'm going to go deeper into student loan consolidation and how student loan payments can affect your DTI and mortgage readiness, all without confusing consolidation with refinancing. So you want to watch that video and continue through my mortgage ready credit playlist. I want to ask again that you subscribe to my channel, join us in the school network, and remember, I'm not just here to help you repair your credit. I'm here to help you become mortgage ready. So let's build it together. See you in the next video.